Got it. Great. All right. The power of a self-directed IRA. First of all, I want to start off by saying, again, what RP Investment preaches is what IRA Club does first and foremost, which is education, education, education. Simply put, our credentials are IRA Club based out of Chicago, Illinois, is a self-directed IRA trust company. We are a full administrator. To give you kind of a better comparison, when you think of IRA Club, I do want you to think, let's say, of like Fidelity, Vanguard, Schwab, or TD being the custodian for most retirement accounts. Well, yes, IRA is a custodian. However, although we do allow you to invest in stocks, bonds, mutual funds, and ETFs, unlike Fidelity, Vanguard, Schwab, and TD Ameritrade being the four horsemen in our industry, we allow you to invest in the alternative space, meaning land syndications, as Anna and Rochelle were just both talking about, and Edward. We also allow you to invest in anything that allows for passive income. Before we jump into, the whole process of self-directing IRAs, I'd like to talk about a little bit about the history behind self-directed IRAs. Kind of gives you a better understanding about why they were created. So the IRA itself, the individual retirement account established by Congress in 1974, was really to address, first and foremost, pensions, believe it or not. Even back then, the Treasury Department quickly realized that they were not offered regularly by the mid-sized to smaller sized companies. Now, obviously, this day and age, 2021, you see them, I don't ever see them being actually offered or even heard of anymore. But they were also there to address government programs such as Medicare, Medicaid, and Social Security. In 2021, it was a staggering number of 2.2 trillion just between these three programs. The other issues that we face is the average retirement account, whether it's a 401k, IRA, 403b, 457 HSA, a TSP, only has $32,000, which is really not that much, and just kind of lets you know the state in which Americans are in. 28% of people over the age of 55 don't even have a retirement account. 40% of millennials haven't even started. The average Social Security check is $1,500. That's non-tax. So after taxes, you're talking about $1,300. There are 2 workers for every 1 retiree. So that's another staggering number, because most economists feel by 2030, that number is going to be, the ratio is going to be 1-to-1, versus back when Social Security first started back in 1935, that was 24 employees for 1 retiree. The reason why that is Americans are just living a lot longer. Back in 1935, you only lived until 62. So you qualify at 65. So you never even made it to Social Security. Now, these are problems that we were facing present and past, but we need to face reality as Americans, and more so as investors. Things that we need to look for in the future is inflation, which is here to stay, in my personal opinion, between now 5 years until the next 10 years, and taxes are on the rise. And that's just because, simply put, if you're looking at this staggering number of stimulus checks at $9 trillion, there is no choice but for taxes to go up, because we are heading into a tax storm. Biden has made that very clear. In my personal opinion, whether it was Biden or Trump, there was no choice but taxes to go up, and really to offset inflation. So for the first time ever, the Biden administration and the Treasury Department are actually in full support of each other. The problem is it's not targeting the average American. It's targeting investors, corporate America, people like you and I that are actually educating ourselves to strive for something better. As we all know, across the board, there's going to be tax hikes. It doesn't matter what tax bracket you're in, but the highest being reduced from 518 to 400. They're talking about reducing the 1031 exchange or limiting it to up to 500,000. The long-term capital gain tax going from 20 to 25%. Again, these are all proposals that have been given to the Ways and Means Committee. A lot of people are actually talking about, what about retirement accounts? I know that is a different subject. I'm more than happy to answer any of that or a follow-up to anybody who wants to reach out to IRA Club. Again, these are all proposals by the Ways and Means Committee. However, I do want people to realize, as accredited investors and people that are traditionally in the 32% tax bracket or higher, you may be faced to paying up to 60%. Again, think about that number. For every $100,000 that you are potentially making, they're talking about taking 60,000, leaving you with 40. So these are some numbers that you need to be wary of, especially if you're making over 400,000. They're talking about raising Social Security to 12.4%, where it's currently at 6.7 right now. State income tax, that's just a broad number. I understand some of you that may be listening to this or watching the recording later, may be living in Texas or Florida. But for example, I live in the great state of Illinois, which is at 7%. Edward, you're in California, including I believe Anna at 13.3% in California. Also, one of the things you need to be wary of, whether you are a passive and or active investor, they're talking about retaining the 3.8%. That's how we're getting close to 60%. So again, these are things that you need to be wary of, things you need to understand. So the $1 million question that we get quite often is, how do you get rid of Uncle Sam and potentially grow your investments 25 to 50% faster? And obviously that depends on how much you're investing, the longevity of the investment. And the answer to that is, as Dennis Blitz, president of IRA Club, refers to it as, the gift that keeps on giving is a self-directed IRA. Now, I want to be fully transparent. Self-directed IRAs are, it's just a marketing term that we use within our industry. Self-direction is ultimately about control, taking control away from the classical brokerage firms and giving it back to you. And I'm going to go into greater detail about that. But the two most common are the traditional and Roth IRA. Okay. All retirement accounts, again, full transparency, are governed by the same set of rules, 90% of them, by the way. That 10% is just really three aspects: the way you could invest, whether it's within stocks, bonds, mutual funds, and ETFs, or the alternative space. When do you pay the taxes? So in this case, the traditional IRA is tax deferred. You take the tax deduction up front if you contribute. And then later on, when you reach the age of 72, which is called an RMD, that's when you pay the taxes. Or if you reach the age of 59 and a half. The Roth IRA, you actually pay the taxes up front. Anything that you use to invest within the Roth IRA, the funds within it, that is all tax-free moving forward. We are here at the IRA Club. We are huge advocates of the Roth IRA. We have actually seen a huge shift from traditional to Roth. We've seen here at the IRA Club, I would say just in 2020, about 3,200 of our clients shift from a traditional to a Roth, doing maybe a partial or full transfer over. So what are the real benefits behind a self-directed IRA? As I just mentioned, control, all right? Giving you the availability to diversify outside of the norm, outside of stocks, bonds, mutual funds, and ETFs, okay? And giving you, again, the availability to invest in what you know and understand best. That is pretty much the only piece of advice that we give here at the IRA Club, because at the end of the day, we can never choose the investment for the investor. Again, it's all about control, all right? We're giving you back the control. Our job is to facilitate the IRA to make sure it is IRS compliant, to make sure all the T's are crossed, all the I's are dotted. And let's not forget the icing on the cake, it's the tax savings, as I just mentioned. What is the problem? What is it that we face as Americans? The truth is 97% of us don't even know. And typically 90% of Americans only keep the retirement funds in three places: banks, insurance companies, and the stock market. In the beginning, back in 1974, when IRAs were first established, their products were called CDs. I don't want to get too much into CDs. Nobody should be looking into a CD. Average rate of return, or better yet, the best rate of return is by Goldman & Sachs at 0.55%. I know I was going to talk about inflation. Inflation as of September is at 5.39. you're better off taking your money, throwing gasoline on it and burning it. That's the truth. So I don't really want to talk too much about insurance companies. That is the last avenue that I would ever tell anybody to look at. However, let's talk about insurance companies and the stock market. With the insurance companies, their product was typically annuities. I'm not going to get into too much detail, but the one that I do want you to be wary about is the fixed income annuity. Insurance companies pay millions of dollars to target people between the ages of 45 and 65. Traditionally, these are people that have build up a good amount of money into their retirement accounts, their 401ks, 403bs, 457s. The real pitch behind that is you don't have to worry about the volatility of the market anymore, where we'll guarantee you anywhere between 3 to 5%, depending on the structure of the contract. You could go Google this online. The average fixed income annuity right now is just under 4%. Ultimately, my personal opinion, I just think they're taking the funds that you're rolling over, your old 401k or your current 401k, which you can roll over into an annuity. It doesn't have to be an old 401k. It can be a current 401k. If you do happen to roll that over into an annuity, the problem is the surrender charges can be quite stiff. Not to mention, if you decide that you want to pull that out earlier, that could be an additional 10% penalty. My piece of advice to people are just understand what you're getting yourself into before you do it. In my personal opinion, annuities ultimately win because if you happen, God forbid, let's just say, you step outside and something horrific happens, you get hit by a bus or something of that nature, which I wish on nobody. They ultimately keep all the funds within the retirement account. So again, they win. You can't pass that along to your beneficiaries unless it is your spouse. You can structure some annuities to make sure that it goes to your kids. Lastly, I do want to go over quickly is the stock market. Mutual funds in particular, as I mentioned, Fidelity, Vanguard, Schwab, and TD Ameritrade, they actually control 70% of all retirement accounts. You're talking about $34 trillion. They control 70% of that. Fidelity being the forefront in that, they actually control just a little under 31%. The Johnson & Johnson family, a privately owned firm. Now, typically, if you take a look, again, something you could Google on your own, the average return of investment within the stock market, or better yet, a mutual fund, is 7%. That is, again, I would say roughly between the last 10 to 15 years. Why do I bring this all up to you? It's because this is a very scary time, in my personal opinion. I know a lot of people did well in 2020. I feel that and most economists feel there is a correction coming in the market. I'm going to give an example of that just in a split second. But what I do want to talk a little bit about is inflation. And as I mentioned, it's at 5.39% as of September. Inflation works against the market. Here at the IRA Club, one of the benefits and things that we're able to see is the way investors invest. As I mentioned, we have open and funded just a little over 10,000 IRA accounts. We have seen a huge movement and shift from the the norm of stocks, bonds, mutual funds, and ETFs over into the alternative space, because that is the best way to ride the inflation wave, is to put your assets and your funds into hard, tangible assets, into alternatives. You need to be able to create double-digit returns. As I mentioned, if the market's given you 7%, and that's what it shows for the last 10 to 15 years, and then say inflation's at 5.4%, and most people tend to forget to talk about fees, and especially hidden fees, which again, we're not going to get into the nuts and bolts of that. But you're basically breaking out even. And that's what I want you to be aware of. So if you're between the ages of 50 and say, 60 years old, and you're thinking about retirement, at best case scenario, you're going to break out even. You have to be able to create double-digit returns. And it's funny how always the market has a pattern, typically always between 8 to 12 years. We already know what happened in the dot-com bubble with, the overzealous tech companies that caused the massive crash of anywhere between 50 to 80% if you invested in the tech world, the Great Depression, the Great Recession of 2008, regarding the housing crashes. And now we're in 2021, and most economists feel that we're looking at a correction between 15 and 20%. So again, the reason why I bring up these numbers is I want to use simple math. And let's just say if you have an investment with Fidelity, Vanguard, Schwab, or your classical brokerage firms at 100,000, and there's a correction of 20%, which brings your account down to 80, assuming you're still contributing $6,000. And the reason why I'm saying $6,000 is the average American only contributes 6% to their retirement funds. Again, market being at 7%, inflation at 5.4%, it doesn't take weeks or months. It takes years to recuperate those funds, just under 3 years. I tell a lot of investors, can you afford to do that? The best way to hedge against that is the alternative space. I mean, think about it. For example, if you have a house on 123 Green Street, or a syndication, or a property where it is insured, the worst case scenario is, let's say the house burns down. Well, guess what? The insurance covers your IRA. The funds just go right back to the IRA. So that is the reason why I highly, highly, highly recommend diversifying within the alternative space and getting outside of the whole set it and forget it mindset that we've been living in the last 10 to 20 years. And here's the best news of all, and most people do not understand or can't see it. One of the positives that we got back from this pandemic is, and although most of it was bad, there was a bright side. 55 million Americans were either furloughed, or they were let go, or they switched over to a different job. There was a huge shift and change in 401ks, 403bs, 457s, TSPs, and QRPs, and everything else that is outside of IRAs. Prior to the pandemic, there was just under $9 trillion in IRA accounts. In 1 year, that shifted to just under 14 trillion. So there's an extra almost $5 trillion sitting in IRA accounts. So again, we've seen a huge movement to the alternative space, and we've seen it firsthand here at the IRA Club. People are looking outside of the market. So most Americans, 60% of Americans plus, have the perfect source of income to invest in the alternative space, and to invest either tax-free or tax-deferred. So those are the positives that I want people to take away from this. Now, a simple example is, and we see this quite often, a Roth IRA versus a taxable account, basically using your own personal funds. We see this again. Someone switches over from here at the IRA Club, they move over funds from their classical brokerage firm over to the IRA Club, $100,000 using simple math. Current age being 50. The reason why I'm saying 50 is, again, that's where you need to be wary and skeptical about what's going on in the market. And I highly suggest looking at the alternative space and diversifying outside of it. So 50, let's just say 50 years old until you want to retire at the age of 62. Expected rate of return, and I'm using real estate as a very conservative 12%. As you've seen by both of these presentations, or all three of these presentations, 12% is extremely conservative. Again, marginal tax bracket being at 29%. If you break down the math, you're saving $100 and almost $23,000 when you use a Roth IRA account. Again, that completely changes the rate of return from 12% to just under 20%. That is the power of using a Roth IRA account. And the process. A lot of people are very skeptical, are very weary. They feel by talking to their custodian brokerage firm that with creating these artificial restrictions, where you hear it on a day in, day out basis, don't do that. It's too sketchy. Don't look at self-directed IRAs. If you had a good broker, or you're dealing with a good brokerage firm, they would tell you to look at the alternative space. And what we do better than most companies is breaking down the process in 3 steps. Opening the account takes typically 8 minutes. or you could just go to iraclub.org and do it on your own by submitting a traditional Roth, simple SEP, or a solo 401k if you qualify. The next step would be to fund your account once you have your IRA account number. 3 ways that you could do so is by a contribution of $6,000 or $7,000 if you're over the age of 50. The 2 most common that we see is an IRA to IRA transfer, which IRA Club will do on your behalf. And lastly, the rollover, which is an old employer's 401k, 403b, or 457, which we will also help you facilitate. Now, once you've opened and funded the account, the last thing to do is choose the investment. Again, the IRA Club, that is the only thing that we can't do on the investor's behalf, is choose the investment for the investor. Just stick to what you know and understand. Again, I try to make this very high level. If you have any questions, feel free to reach out to iraclub.org. You could give us a call, 312-795-0988. Or you could email me, or you could simply, again, just go to iraclub.org and you could schedule a 15-minute Q&A. I hope that was very educational. I do want to thank everybody for their time and thank the rest of the team.